very fitting topic for the traits of the cryptocurrency market is a term you may have heard before, and that's the tortoise versus hare theory. Famously known from the principles of slow and steady wins the race, this lesson is also essential to be combined with the dollar cost averaging strategy. We are seeing a shift of newcomers coming to the market who are looking for immediate returns and instant riches, expecting endless rises of 1,000% week in and week out. Even worse, people with no investment experience being tricked into buying scam altcoins and ICOs. Even with no intention of actively trading cryptos, uninformed investors will be struck with fear from the volatility and start to lose all rational thinking, day trading their holdings as a result by swapping between coins frequently in an attempt to recoup losses. Which in reality, these losses are just minor falls, less than 10%, that usually last a week max. That is not investing. That's fear and greed leading to irrational buys and then praying for overnight millions. And before they know it, they have eaten into so much capital from selling at losses and buying at highs. We will refer to these investors as the hare, fast and uncoordinated. Ironically, if they had done the exact opposite and followed the principles of the tortoise, slow, patient and calculated, they would be in a much better position financially. Let's put this straight into a real-life example and use two charts to understand this approach further. We'll start with the US stock index S&P 500, as it has proven to be a test against time for the patient investor, providing incredible returns for those who mastered the tortoise mindset. The chart dates all the way back to 1992 and extends to the present day. While I'm in no way suggesting the cryptocurrency market will replicate the exact growth of the chart, or that you should hold for decades, the cryptocurrency market is so young right now that the prices we are currently at are minuscule compared to the growth we could be experiencing over the next decade. Looking at the S&P 500 chart, we notice immediately after reaching all-time highs of $1,551 in 2000, over the next 3 years price crumbled over 50% to $770. It then took another 4 years to reach 1,550 region again, only to immediately melt over the next 2 years, even lower than the previous crash to $670. It comes with no surprise these crashes would have wiped many investors out the market from fear of either losing some of their already made profits, breaking even, or even making a loss. And if we zoom to a closer perspective as the crash was happening, before we started climbing higher again, you can see why. It looks like price would continue falling until it hit zero. The papers, media, and Wall Street were claiming it was the end of the stock market. It was overall a chaotic situation. This is the stage where paralysis hits you and clouds your judgment. You start to see it as rational to panic sell and cut your losses, to re-enter when the market reverses. The problem is, every time the market began reversing, it was only to create a new lower high and continue its downside fall. It's common to see this kind of behavior in these market conditions. Yet, if we zoom out again, we see the fall in value was temporary. We regained all-time highs eventually, even breaching these levels to currently $2,500. Take note of the word temporary. Every directional swing in the market is temporary, and only the investments with real use cases will always continue progressing higher through these temporary cycles. It may have taken a few years, but that's exactly the investment approach we are taking with cryptos anyway. We want to sit through these drops, whether that's 20% or 80%, because in this current point in time, and in fact for the next 5 years, the market will reward the patient, emotionless investor in the years to come with huge percentage gains. Veteran investor and multi-billionaire Warren Buffett abides by these principles and praises them for his long-term success in the market. The tortoise is all about longevity, and the hare just wants a quick dollar. The profits you took from a panic sell could have been left to grow over 20 times its original amount, especially in cryptocurrency. Let's take this fresh outlook to a chart you will be analysing a lot. Shown is Bitcoin's huge collapse in 2013 after breaching all-time highs of $1,000 for the first time. I've purposely extended the chart to 2015, just before the reversal, so you can see exactly what investors would have been going through during this period of time. I can see 10 fake reversals on this chart timeframe alone, where investors would have sold in a huge loss, tried to buy on the reversal, and then had to sell again after the position fell even further in value. At the current Bitcoin price of $6,000, it's extremely interesting to see the people that have hundreds of millions of dollars right now are the investors that started purchasing since Bitcoin was less than $1 in 2010 and completely forgot about their investment over these years. Or they continued buying regardless of price, whereas the day traders who are trying to analyze the market, every tiny move up and down, have barely a fraction of the long-term holders have now. This notorious video of an early adopter who sold all of his 30,000 Bitcoin at $300 during the downfall helps us see the impacts of selling because of temporary moves manipulated to shake us up. Whilst we cannot fault him for selling at a profit of $9 million, had he held on just 2 years more and rode the volatile waves, his 30,000 Bitcoin would now be worth $180 million. The Hare took home the quick profits. The Tortoise would have made exactly 20 times that amount just by sitting on his hands. Because Bitcoin hasn't been around as long as the S&P 500, we can zoom out and identify the price we're at now could be minimal compared to what it may be in a few years' time. As the S&P 500 chart and history has proven for all financial markets, Bitcoin is yet to have another huge crash, and just by understanding this, we can anticipate this due to happen in the future and also for every other crypto at some point. We have to use initiative and be smart with this information. We do this by taking a small portion of profits and continuing to let the rest compound over time. Taking all profits off the table is fearful behaviour. Withdrawing slow amounts over extended periods of time is smart. If price falls, we can then reinvest with our profits ready on standby. This part of the strategy is covered in the profit-taking lesson, which will follow on from dollar cost averaging. These 4 lessons are combined to form the perfect buy, hold, profit-taking and reinvestment strategy.